8 are mathematically related, 3 depends. The rest are principles and practices related. So it's called an appraisal. So the appraisal is an opinion of value. That's what an appraisal is. And it's rendered by the appraiser, a licensed individual. And it's art and not science. And the appraiser has to conform to the uniform standards of professional appraisal practice. It's a standard established under that law we discussed before you went on break, the Financial Institutions Reform. We come in for that. They establish a board called the Appraisers Standards Board. And the Standards Board says that the appraiser, when providing a report, have to conform to the uniform standards of professional appraisal practice. And also the fee for the appraiser must be based on time or difficulty. It's the appraiser's opinion of value, and it is a written opinion that the appraiser gives in order to justify the value of the property. A comparative market analysis, which the licensee prepares, is also an opinion of value, but it doesn't have a standard. It does not have a standard. We don't put any standards to the comparative market analysis, therefore we cannot call it an appraisal. It doesn't have a standard, it doesn't have the USPAP standard, and we are biased when we do provide that value. So there are basic differences between the two opinions of value. In the appraisal, the appraiser uses properties that are sold only, and the appraiser is a non-biased individual and has to conform to the uniform standards of professional appraisal practice. In a comparative market analysis, or a BPO in some cases, broker's price opinion, we use 3 sets of properties: the sold, on the market, and this is expired. And we are biased because we are involved in the transaction in order to get paid, and there's no standard for us to maintain. And that's why we cannot call the document an appraisal, because there is no standard. Appraisal has a standard. The CMA does not. It can be paid for both, and the broker is the one who gets paid for the opinion. The appraiser gets paid for his or her opinion. The broker is the one who gets paid for the CMA or a BPO. Sometimes we give it for free. The value that is most common in appraising is called market value. And market value definition is the most probable price the property should bring on a certain date when the owner is conveyed merchantable title to the buyer, and both parties are under no compulsion to buy or sell, and neither party is worked with knowledge, and the property is exposed to the market for a reasonable amount of time, and cash to seller, no special financing, and no stimulus. That's what the appraiser goes out there to determine what is the most probable price this property should bring in an open and competitive marketplace. All conditions requisite to a fair sale, where parties are working with knowledge and they're under no compulsion to buy or sell, and cash to seller, no special financing. And that's what the appraiser is going to determine. What is the most probable price? Not the price. Price and value are 2 different things. Value basically is the most probable price. Price is what the property bought or sold for, or is offered for sale. For the product to have some form of value, these are the 4 characteristics that must be present. And that's where the appraiser goes out there to determine if these 4 are present in the product or the property. There must be demand for the property. Demand means the desire, the need, and the means to acquire. That's what demand is. It must be useful. It must have some form of utility. There must be some form of scarcity. That's why the appraiser goes and checks and see how many types of properties of this nature are available. Because the scarcer the product, the more valuable it becomes. Then there must be transferability. It's called exchange value. It must be exchanged for something else. That's why we use properties that are sold, because it's exchanging for something else. And that's called transferability. The properties don't have to be alike. They don't have to be homogeneous. They could be heterogeneous and still have some form of value. Once they have these 4 characteristics, then value can be established, which is the most probable price it should bring in that open marketplace. Question: all the following are characteristics are normally taken into account when determining the value of the good, except homogeneity. The products doesn't have to be alike. It could be heterogeneous. Keep that word in mind. The product can be heterogeneous. That means they're unlike. That's why no two properties are alike. We can use comparables or somewhat similar, but they're never alike. And that's why we have to make the proper sequence of adjustments in order to determine the final estimate of value. So when we go there are three approaches to value the appraiser has to use based on the uniform standards of professional appraisal practice. And the first of the three is called the sales comparison approach. And it's based on this principle called substitution. And what substitution says, a prudent buyer will pay no more for a property than the cost of acquiring through purchase an equally desirable alternative. An equally desirable alternative. And that's why we go and find comparables that buyers and sellers have agreed to. And that is a barometer where value can be established, price to value. So the appraiser goes out there and collects the data and have to make the proper sequence of adjustments. And the adjustments are always made to the comparables, never to the subject. And you learned that from Dan on Friday. Comparable better, you subtract. Comparable inferior, you add. You cannot touch the subject. You always make the adjustments to the comparables, bring it in line with what the subject should be like. And then the most important part in the process is called reconciliation. The appraiser has to reconcile the various estimates of value. Because I'm using 10 properties, I have to basically reconcile those 10 numbers to get to a final estimate of value. So what does the appraiser adjust for? It adjusts for transactional differences, locational differences, and physical differences. Those are the sets of differences the appraiser adjusts for, and they will adjust the comparable. Keep that in mind. They will adjust the comparable and not the subject. And if the comparable is better, the appraiser will subtract the monetary adjustment. The comparable is inferior, the appraiser will add the monetary adjustment. Just like you did with some of the exam questions that you will post to you in the school exam. Question. The process of arriving at the final estimate of value in appraising is called
reconciliation.
It's called reconciliation. The most important step in the appraising process. You have to reconcile those final estimates of value. Brokers, reconciliation involves weighted averaging. Keep that part for your broker exam. Reconciliation is based on weighted averaging, not simple averaging. Which of the following combinations would be agreeable to an experienced appraiser? Well, we know A is not a good combination because special purpose properties do not generate income. We know B is not a combination. Income, owner-occupied home, don't generate income in return to value. And we know residential land, we can't use the cost approach because land does not depreciate. And therefore, the market approach, also known as the sales approach, means the same. The words are used interchangeably. The market approach is also known as the sales approach to vacant land. That's why we go and we find land that's sold recently in order to find its value. Because land does not depreciate, land doesn't earn income in relation to its value. Therefore, we have to go out and find land that's sold recently and sold appropriately in order to determine its value based on the sales or the market approach. The cost depreciation approach is when we cannot find good comparables, when the property is new construction, or we do it for insurance purposes, or governmental properties, or specific use properties. When we cannot find any good comparables, we have to build the property on paper, like you did with Dan on Friday. How are you going to determine value based on this approach? Because there are no comparables and it's not income producing. So we have to go and we have to build this property on paper. And we always start with the reproduction or replacement costs. And how we do it, there are three methods of doing it. The first and the most accurate, the most time consuming is called the quantity survey method. It's taking each item to reproduce or replace the building, because it can only reproduce or replace buildings, not land. Land is fixed in its location, can't reproduce those things. And therefore we can reproduce the building itself. So the quantity survey method is a method where we take every single item to reproduce or build the property, quantify it, and value it, the most time consuming. Then we have the unit in place method. The components we put into the property, how we will put them in order, and we will have to quantify them and get some form of value. The easiest method is called the unit in place or square foot comparison method, or compare the square foot method, which you did hopefully on Friday, taking the square feet times the cost to reproduce, and that would be the reproduction or replacement cost. Then buildings lose value through depreciation. There are three types of depreciation that the building loses its value over time. The first of the three is called physical deterioration, the wear and tear of the building, or physical depreciation. Building loses value through being exposed to the elements over time. Then we have the functional obsolescence type of depreciation, or functional depreciation, because the building is outdated, does not meet the current code, it's built in the olden days, so it's not normal, it's not modern. Therefore, it suffers from some form of functional obsolescence. Then we have the external obsolescence, also known as economic obsolescence, because of the outside of the boundary lines of the property that influences its value. Things outside the boundary lines, like zoning and traffic patterns and high crime, and all these things that are outside the boundary lines of the property that has an effect on value. So these are three types of depreciation that the appraiser accounts for. These three could be curable or incurable. Curable means the cost to cure is less than the increase in value to the property. Spend less and you achieve more. So when it comes to curable, we can cure physical and we can cure functional. We cannot cure external or economic. Incurable means the cost to cure is more than the increase in value to the property. So incurable can be applied to physical, incurable can be applied to functional, incurable can be applied to external. So external cannot be cured, is usually incurable. Can move the location because it's fixed in its location. Question: all the following are types of depreciation except there's no such thing as physical obsolescence. Functional obsolescence, external economic obsolescence. Physical obsolescence do not exist. It is what it is. You cannot change it. And it could be obsolete physically. Functionally, yes, not physically. Which of the following would be functional obsolescence? All functional obsolescence. Which of the following appraisal approaches is the land valued separately from the improvements? Exactly what you're doing right now. What are we doing right now? Or the cost depreciation approach. The land is valued separately from the improvements. The land does not depreciate. So the following would be an example of external obsolescence. Outside the boundary lines of the property. The rest are either physical or functional. So the following is not a step in the cost depreciation approach to estimating market value. We never use the income. Income is only the income approach, not the cost approach. Which of the following is usually incurable?
External.
The following is not an example of physical depreciation. Now we come to the income approach. It's based on the principle of anticipation and also the principle of substitution. We anticipate the income and we substituting rates in order to get to the value of the property, that capitalization rate. So you did it with Dan on Friday. we go and based on the principle of anticipation, we anticipate what the income should be. We start with this potential gross income. And then we will look into the marketplace and get a vacancy factor and apply it today to get our vacancy and collection losses. Then we will subtract one from the other to get our effective gross income. Then we will look at the operating expenses. You look at the fixed expenses, there are only two, like you discussed on Friday. You have your property taxes and insurance. Those are fixed expenses. You have your variable expenses, there are four. You have your management, maintenance, repairs, and utilities. And then there's reserve for replacements, where the appraiser puts aside whatever amount they think is appropriate. Usually is a percentage of the potential gross income to get to the net operating income. And that's the income the appraiser capitalized, like he did on Friday, by using the formula. Taking the income divided by a rate that comes to the marketplace based on the principle of substitution. The rate comes to the marketplace. The income comes to the property. And therefore, we can find value by taking the income divided by the rate. And we'll get value for the subject property. And that's exactly what you did mathematically on Friday or sometime in the classroom. It's called a, keep in mind, operating expenses do not include, keywords, and they put it there in your exam, operating expenses do not include mortgage payments, income taxes, and depreciation. One more time. Operating expenses do not include mortgage payments or debt service, income taxes, and depreciation. They're not part of the operating expenses of the property. Question, which of the following are not subtracted from the potential gross income to arrive at the net operating income? We just talked about it. Mortgage payments. Don't take that as part of the analysis. In an income approach to appraising, the value of the dollar collected today is what you have in your hand today. Is it worth more or less what you expect to get tomorrow?
More.
Oh, it's always worth more. The bird in the hand is worth two in the jungle. That's in mind. What you have today is more than what you expect to get tomorrow, because you don't know what tomorrow brings, do you? Tomorrow is just a dream. If you know what tomorrow brings, you should not be here. Stay home, get a landline, call yourself and Cleo. Give psychic advice. You can know if you pass your exam or not. So what you have today is always worth more than what you expect to get tomorrow. Keep that in mind. In the income approach evaluation of real estate, the main steps are: one of the techniques of taking multiple choice exams, and you see a plural form of question, you always look for the longest answer. And the longest answer will be your correct answer, because you have to give you everything in the answer. What's the longest answer in this question? That's the correct answer. Or all the above. So when you see those things, you know that will be the correct answer. That's another trick you use in your exam. Right? When you see things like steps and procedures and anything else, and you see all the above, and you see it, you know all the above, you see a longest answer, then you pick the longest answer. It will be right. That's another way of passing an exam without even studying. Appraisers are appraising an apartment building in a college town, and the student leases are below the market. What type of rental income would the appraiser use to value the property? Appraiser says, I need to use the rent. What rent am I going to use? Am I use contract or economic? I will use economic rent. What it should bring? Contract rent, I only use that if I'm going to determine investment value. It's called contract rent for investment value, economic rent for market value. So, chapter 17, there are 3 questions on this chapter. It has to do with investment, and it has to do with investors' objectives. The investor goes out there and contemplates buying an investment. So there are objectives that the investor has to justify. And the justification is that how safe is my money? you have enough questions in the PowerPoint.
Oh, okay.
Right? That's all the questions I can ask you. So, you have safety. How safe is my money? That's my principle. Is it protected against inflation? And how liquid the investment will be? Can I convert into cash immediately? And how much income is earning? Because that's how I determine value. The actual income the investment is going to give the investor, and the tax benefits that the investor is going to achieve from that investment. They're called objectives. Every investor has to set a series of objectives. What am I trying to achieve? And that's the investor's call, and the investor is the one that makes the decision. One of the concepts investors use is called leverage. Know the definition of leverage. Leverage is the use of other people's money to make more money. It's borrowing money to make more money. And it comes in two forms. It could be positive leverage or negative leverage. Positive leverage occurs when the investor is making more on the investment than it costs to borrow the money. I'm making more on my investment than I pay to my lender for the money I'm borrowing to make an investment. Negative means the lender is making more than I'm doing, and that's called negative. So the investor makes more than the lender, is positive. The lender makes more than the investor, is called negative. It's called other people's money or trading on equity. Those are forms of leveraging. You go and we acquire a larger asset, which doesn't money is down, and that's how we leverage in order to make more money. When it comes to leveraging, there's a risk involved. And there are two types of risks that the investor is going to take into consideration. And all of these risks, business, financial, purchasing power, interest rate, market, and default, comes under a general risk known as dynamic. Know the term. It's called dynamic risk. And that's the risk the investor cannot insure. The investor has this dynamic risk in the rate of return. That rate of return includes some form of dynamic risk. Static risk, on the other hand, is insurable. Static risk, the investor insures and pays that on a monthly basis or an annual basis, and is part of the operating expenses. So dynamic is not insurable, and these are all types of dynamic risk. Static risk, on the other hand, that investor is going to insure for things like fire and theft and vandalism and natural disaster. They can insure that, but they can't insure these things. Which of the following best describes positive leverage? Leverage is always from the viewpoint of the investor, never from the lender. The lender is making money by charging an interest. You want to make more, make it positive. If one is making less, it's called negative. Then it comes to taxation. There is different benefits the IRS code gives to the homeowner as opposed to the investor. The homeowner has the right to claim on the 1040 each year the property taxes on the property they're living in and the mortgage interest on the loan they have borrowed to finance the property. That's what they can claim. Investor, on the other hand, can claim the operating expenses that we just talked about. They can also claim the interest on the loan they have borrowed to finance the investment. And they have what we call a depreciation allowance that the IRS code gives to the investor for having that investment. And the depreciation is on a straight line basis. And you need to know the years that the investor can recover the building part of the investment, not the land. Investor can only depreciate buildings, not depreciate land, just like in the cost depreciation approach. And straight line. So what the IRS code says, if you have a residential building, you can recover it over 27.5 years. If you have a non-residential building, you can recover it over 39 years. Those are the timelines you can recover your building value over 27.5 or 39 years. That's what the IRS code gives the benefit to the investor. It's a deduction one can take from under 1040. The homeowner cannot take that deduction, the investor can. That's the difference between the two people filing for the tax return. When it comes to investment, and one sells the investment, one incurs a gain. There's a long-term gain as a short-term gain. Long-term gains are gains that occurred when the investor held the property for more than 12 months. More than 12 months. It's called a long-term capital gain, and the tax rate on that gain is 50%. Tax rate on a long-term gain is 50%. Investor sells the property, incurred a gain, and held it for less than 12 months. Then it's called short-term. A short-term gain or tax at the investor's regular tax rate for that year. Gains offset losses. So capital gains offset capital losses. And if there's excess losses, the investor can only claim $3,000 of those excess losses in any 1 year until they can use it up in the forthcoming years. Maximum capital losses I can claim every year is $3,000. And the balance is carried forward to the forthcoming years and claim it at $3,000 a year until it's used up in the forthcoming years. So that's called capital gains and capital losses. When it comes to business brokerage, what they will test you in your exam is what type of license you need to market and sell businesses. There is no such thing as a business broker's license. Do not think that's an answer. There is no such thing as a business broker's license. You need to have a real estate license to market and sell businesses. Your exam question is there. You need to have a real estate license. It's a service of real estate, and that's why you need to have a real estate license. An additional license one you need to have is called a securities license, if it involves the sale of limited partnerships and shares. But the real estate license is mandatory. You must have it in order to market and sell businesses. And what they'll test you on also is the two financial statements that you need to be familiar with. Know what the balance sheet is and know what an income statement is. The balance sheet that the business produces shows the financial position of the business at its stated moment in time. The financial position, the value of the assets, the liabilities, the shareholders' equity at a stated moment in time. It's called the business's financial condition. Then we have the income statement showing the operations of the business over an accounting period. It's called the profit and loss. It shows the revenue, it shows the expenses, it shows the profit or losses over an accounting period, usually a 12-month period, annual or fiscal year period. And that's the two statements you need to know. Those are important statements to test you on, the balance sheet and the income statement. And they also will test you on an intangible asset called goodwill. Goodwill is where the business is worth more than the sum of its assets. The business is worth more than the value of all the assets. It's called goodwill. Goodwill is an intangible asset when the business is doing pretty good. And that's the reason why we go out and value the business based on its going concern value. Know the value of the business. It's called its going concern value. It's worth more than the sum of its assets. Then the other value we go for businesses is called its liquidation value. The liquidation value is where the business is not doing well and it has to be liquidated. So those are the two values the appraiser goes out there to value the business. Its going concern value, that means it's worth more than the sum of its assets. Or its liquidation value, that means it's not doing too good. And that's why we have to liquidate the business. Those are the things to test you on. There's nothing else they can test you on concerning a business. Question. The purchase price of a business, that's the value of the tangible assets of that business, equals the intangible assets known as goodwill. It's called goodwill. An intangible asset that if the business is doing pretty good, it's always there. When the appraiser goes out there to appraise a business, these are the three methods that are used to determine its going concern value. You have the market approach, you have the cost approach, and you have the income approach. It's to determine the business's going concern value. And then the additional approach the appraiser has to use to determine the business's liquidation value is called the liquidation approach. These are the four approaches the appraiser uses to determine the value of a business. Either its going concern, That means it's worth more than the sum of his assets, or its liquidation value, which means that the business has to be liquidated. And that's all you need to know about the business appraisal. So let's go to the back of the book and let's look at some questions concerning this concept. Let's go to question 129. Question 129 says, what is required for a person who represents himself or herself as a business broker? They must have a very good real estate license. See, you guys know the knowledge. So don't lose it. Question 130. Which term refers to the tangible and intangible resources of a business? They're called assets. Tangible and intangible, they're called assets of a business. 131. Which asset is most difficult to set a dollar value on for a business? Goodwill. Very difficult to assess. What is the value of goodwill? And that's the most challenging part of business appraising. What we're going to put for goodwill. So, 132. John has an opportunity to invest in a property with a 9% return. He can borrow money at an interest rate of 7%. Which investment characteristic exists? Positive leverage. Very good. I'm borrowing at 7, I'm making 9. That means I am making a positive leverage. Question 148. Question 148 says, the two most important financial summary statements of a business are the balance sheet and the income statement. The two most important financial statements. The balance sheet shows the financial position. The income statement shows the operations of the business. Question 150. Which financial statement shows the status of the business as of a specific date? The balance sheet shows that as of a specific date. That's called the balance sheet. Financial statement that shows the status of the business. It's called the balance sheet. Question 342. I'm sorry. Question 342. Question 394. Yes. Question 394. What would be an investor's motivation for deducting depreciation? To maximize their cash flow. Maximizing the cash flow. Because you pay less taxes, and that means you get a larger after-tax cash flow. So chapter 18, there are 3 questions, or 2 questions in fact, or 3, I can't remember. Chapter 18 has to do with property taxes. And property taxes are known as ad valorem taxes. That means it's the only tax that's according to value. It's according to value. That's what the word term means, ad valorem. And it's levy on property. That means it's a tax levy. And it's paid in arrears. It's assessed on a calendar year basis from January 1 to December 31st. It's paid in arrears, and that's why you have to prorate the taxes if the ownership changes during the year. And it is due in November. Taxes for the current year is due in November, and if it's paid, there's a 4% discount. Paid in December, 3% discount. January to February 1, and is payable by March 31st of the following year. Becomes delinquent April 1 of the following year. There are 3 levels of taxes that are levied on the property. You have the city, county, and school board, and it's based on the millage rate. And the statutory requirements are they cannot exceed a 10 mil cap. Bond issues can make it go over the cap. It is part of your taxes, but for budgeting purposes, 10 mils is the maximum. So when they go to do their budget and they go to collect the money from the property owners, that is the millage rate that they have to charge on the assessed value of the property, minus whatever exemptions the property owner can claim. So the assessed value is determined by the county assessor or appraiser's office, and is sent to the property around August. And if the property owner does not like the assessed value, they can protest it. And you need to know the sequence they have to go through to protest the assessed value. And the sequence is, the first step, they have to appeal to the county assessor or appraiser's office. And if they do not get any satisfaction from this individual office, they can go to the Value Board of Adjustment. And the Value Board, you need to know the makeup. It is made up of 5 people. 2 are appointed, 3 are elected. You have 2 county commissioners that are elected. You have 1 school board member that is elected. You have 2 consumer members that are appointed. It make up the Value Board of Adjustment. It is a county board that basically is there to give relief of assessed values. And if they don't give the owner any relief, then they can go to court and litigate. You can go to the District Court of Appeal and start the appeal process. So know the steps that the owner has to take to appeal the assessed value of the property. So when it comes to properties, there are 2 sets. One that are properties that are immune and properties that are exempted. Know the difference. We always put the question on these types of concepts and people get very confused. Immune properties do not exist for property tax purposes. All government-owned properties, regardless of which level of government owned the property, they do not exist. For one reason we discussed this morning, because we have the allodial system of real property rights in this country. The government is not in the business of owning real property. Therefore, the tax burden falls to the people in the community. You have to pay the standard tax burden. The government, well, these are my properties, therefore they're not taken into consideration. All government-owned properties. Exempted properties means that the properties are taken into the tax base, the taxes are calculated, and the owner of the property is allowed to claim an exemption. The owners have to claim the exemption. The property is taxed. The owners have to file for the exemption to prove that they're not entitled to pay the taxes. And they're called exempted properties, either full or partial exemption. Well, full exemptions goes to non-profit organizations, churches, and these non-profits. They don't pay the taxes on the properties they own because this is exempted property. Then you have the partial exemptions for homestead. Then you have the quadriplegic, who basically will get full exemption. And these are what we call exempted properties. Properties that can claim an exemption. They're not immune, but the homeowner has to file for the exemption. And if they don't file for it, they would not get it. That's called an exempted property. So when it comes to one of the exemptions one gets, it's called your homestead tax exemption. One has to file for it. And the filing time is between January 1 and March 1st. And one gets the basic $25,000. The basic is $25,000 for homestead tax exemption. And one gets some additional exemptions if one is a disabled vet, 10% service-related disability, one gets an additional $5,000. If one is a surviving spouse, one gets an additional $500. If one is